Realty Shares founder Nav Athwal talks future real estate investing, show 056.
But my first set of experiences were people laughing me out of the room. When I was pitched my idea telling me, you're going to get sued, this is never going to take off, I got a lot of no's. And those early no's are very, very discouraging and also almost derailed me. But then someone told me, I was talking to a friend, and I still remember this piece of advice. And they said, don't quit. Keep going, have perseverance, have grit. And honestly, that's helped me drive the company Realty Shares to where it is today, because I've had a tenacity and grit that I formed very early on through a lot of rejection, through a lot of failure. And you have to have that to build a successful company.
I'm Mitchell Chadro, your host on the Listen Up Show that helps you and your startups grow your business and teaches you how to balance your business with family and life. On today's show, we're speaking with Nav Athwal, and you can actually go to www.realtyshares.com to get more information. Realty Shares is an online marketplace for real estate investing. It has over 120,000 registered investments, and it has surpassed $500 million in capital deployed with over 1,000 projects in 39 states. Nav has published articles on Forbes. He has been featured on CNBC, Bloomberg, and Fox Business. Want to learn more about how to start up a business? Sign up for our newsletter and get access to exclusive content, plus a free copy of our ebook, 30 Tools to Start Up. Get my free ebook now. Just head on over to mitchellchadro.com/sign up. That's right, mitchellchadro.com/sign up. On the podcast show, we speak with successful entrepreneurs, private equity investors, nonprofit student leaders, startups that have grown successful businesses, and those serial entrepreneurs that have built iconic brands and have sold their businesses for millions, fintech gurus, app developers, and so much more. Now enjoy the show. What are we going to speak with Nav about on today's show? How does Realty Shares work? How do you make business more accessible, efficient, and transparent? What does it take to build a leading online marketplace for real estate investing? How Nav took the old real estate model and actually made it easier, simpler, and more accessible to everyone, and how you can use the same techniques in your own service industry for your own products and solutions. We speak about the old models and fee structures and how he implemented the new models and the thinking about what it will take so you can apply these concepts to your own hustles and your own startups and your own businesses. How did Nav first come up with the value proposition for his product, service, and solution? And what do you need to be thinking about as you listen up so that you can apply what we teach you today, what you're going to learn here for your own businesses? Nav has truly transformed the real estate investing market, and we will hear what's in the future for real estate investing. I am so excited that Nav is joining us on today's show because, as I said, Nav has done so much to transform the real estate industry. As a real estate investor and fintech entrepreneur, we can all learn a lot about what it takes to build a business, how to get capital, and transition your online business in an ever-changing industry from Nav. Nav, welcome to the show, my friend.
Hey, Mitchell, really great to be here. Thanks for that amazing intro. Can't wait to chat.
Well, you know, we're so excited. I've read up so much about you, and I was so excited to bring you on to the show because I know how much the audience is going to gain from all of your expertise and your knowledge. I mean, you have certainly come a far way from those humble beginnings more than 4 years ago when you were just starting out in your living room attempting to build a small business we all today know as Realty Shares.
Yeah, it's been quite the journey. A lot of ups, a lot of downs, a lot of amazing milestones. Wouldn't trade it for the world. It's been one of the most amazing rides of my life, the best learning experience I've ever had in my life. I tell my friends who've gone to school to get an MBA. I feel like I've gotten 20 MBAs in the last 4 years. So it's just been an amazing ride. I'm a passionate real estate guy. I love technology, and Realtyshares has been a happy marriage of my two passions. So it's just been an amazing place to be, and I can't wait to talk more about it with you.
Well, tell us, how does a professional drummer and avid biker get this expertise in finance?
Well, once upon a time, I was a drummer. I bike for fun, although I do not tell folks I'm anything but an amateur. But finance, real estate has always been a passion of mine. I spent my career in real estate brokerage, real estate law, where I was a lawyer for about 4 years. Was an active real estate investor, out of the 2011-12 time frame. So I've been very fascinated by real estate. And then on the flip side, prior to getting into the world of real estate, I was actually an engineer. So the technology piece has been a part of my kind of DNA since I first graduated from college. So I really got fascinated by just technology's application to big markets like real estate back in 2011 and 12 when I first started conceiving of the idea behind Realtyshares. And at the time, I started noticing a lot of amazing trends in the fintech space with Lending Club and Prosper. I know you had Ron Super on a prior episode, and just what.
Oh yeah, that was really exciting.
Yeah, he's a really good guy, really passionate about the space as well. I've personally learned a lot from him just through various coffees and lunches I've had with him over the years. But, at the time I was thinking about Realtyshares, Lending Club and Prosper were already starting to originate billions of dollars worth of loans every single year. So I saw this trend in consumer through these pioneers like Lending Club and Prosper, and was amazed that someone hadn't done the same for real estate. So it was watching early pioneers, my passion in technology and real estate, that got me going within the space, and it's been an amazing ride, as I mentioned. I think we're building something truly unique and truly special for the market.
So now that you've actually transitioned out of your role as CEO of Realtyshares and made your way, and you're making your way for a new CEO who can obviously scale the company and lead it into its next chapter, how does it now look on the other side looking in?
It's quite different. So I transitioned out of my CEO role about 4 weeks ago now. It's been about a month. It was right before Thanksgiving. And when you're the CEO, you're every waking hour you're spending on the company, whether it's helping think about strategy, hiring new people to join the company, raising capital. I mean, every single second is accounted for, and you're working harder than anyone else. I mean, you're really setting the tone for the rest of the company. So you don't really get as much time to reflect. And I think a lot of CEOs and companies need to make time to reflect, because you can get so bogged down with the day-to-day that you lose sight of the big picture. Now that I've stepped out, I really have had a greater opportunity to look at the macro and reflect on not only what we've accomplished, but what we still have to accomplish as a company, because I'm not there in the day-to-day every single day. I mean, when I left as CEO, I brought in a new interim CEO, Ed Forrest, who spent his career on Wall Street at Goldman Sachs, and after that ran Cushman & Wakefield for about a year and a half. He's a really great guy, a seasoned executive, and he's running the company now, and I get to really look inside and look at it from more of a strategic board level viewpoint, which is a lot different, obviously less involved than CEO, but just gives me a very different perspective on what the company's accomplished and what we still have to do as a company, which is pretty special, because I also have that context from being CEO that very few board members have.
Well, we're going to talk to you a little bit about the team and all the various members. I know that he is an interim CEO and that you're looking for a more permanent one, so we'll certainly have questions later in the show regarding that. But let's go a little bit deeper. You touched upon it very briefly in the beginning. How did the idea actually come to you? Because at that point, it's 2013. Of course, you're still working for the law firm, as you had mentioned before. Tell us how you were able to keep going at the same time. In other words, balancing all of that and then coming up with the idea and then executing on it during that time.
Yeah, that brings back memories. So the idea for Realty, so I've always wanted to pursue something entrepreneurial. Even when I was an attorney, for me, it was kind of a stepping stone to something that was going to be more in the business world. I didn't know exactly what how that would take shape, but I always knew real estate was a passionate area for me. Whether I ended up doing something in, traditional real estate from a business perspective, whether it's real estate development or investments, or in the technology space, that was still TBD back in 2012, 2013. But, in 2012, in 2011, 2012, I started buying real estate for myself. So I was buying apartment buildings, single-family homes up and down the Bay Area in the Central Valley. And I was working with someone I met when I was at UC Berkeley Law School. He was at the business school there. We both started partnering on these projects. And every time we tie up a great property, our single biggest area where we were spending time was raising capital. We were trying to get debt capital in place. We were putting equity capital in place. We lost a lot of really good projects because we weren't able to put that capital in place in time to close on the deal. And so we were both having a beer one day, and I mentioned to him, I'm like, look, there's this concept of crowdfunding and online lending. It's taking shape in, the consumer lending world and the student lending world through players like SoFi, but no one's really doing this for real estate. And it's one of the single biggest pain points for real estate developers and investors is raising capital, managing capital. So after, just going through those motions of having to raise capital for our own projects, we were both passionate about technology. We started putting together the initial phases of what became our first business plan. And it literally was in my living room in San Francisco. And so that's really what the genesis of the idea was. And we were both employed. He was in the real estate private equity world. He was working for a large private equity shop. I was working for a 200-person attorney shop in San Francisco. We both had great, well-paying jobs. We started moonlighting nights, weekends. Every free hour or second we had from our day jobs was being spent on coming up with this idea. And for the first 6 months, we didn't even have a name. We just called it, I forget what name we came up with, and then it transformed into Realty Shares. It was really hard. I mean, balancing a demanding job as an attorney or a private equity professional with starting a startup, I mean, it's one of the hardest things I've ever done, but it also was a lot of fun. I mean, we got to innovate every day. We were coming up with new ideas. We were whiteboarding things. I wouldn't have traded that time period for the world. And we did that for about 7 months before I jumped ship and decided to pursue this full time. And at the time, he just didn't have the capacity to do it. So he ended up transitioning out, when I went full time. We're still good friends. We still talk often, but that's when we sort of parted ways, and I pursued this on my own, and I never looked back, and only recently did I transition out.
Well, the audience is obviously trying to balance their own businesses with their family and life. So I know that in hearing your story in terms of how you got started, that's certainly going to motivate them as well. As far as the team goes, when I talk to you a little bit later on in the show, we're certainly going to talk to you about the co-founder to find out his personality and his strengths and his weaknesses in terms of the team. You had also brought up crowdfunding, and I know that we actually had an entire show back on show 015 about crowdfunding, and so we're certainly going to get into that with you in a little bit. But one of the other things that I'd like to do is I'd like to kind of turn your focus to the future. And so what is the future of Realty Shares?
So we have our vision at Realty Shares, when we first started, it was really just to make the process of raising capital for private real estate much easier, much more transparent, and at the same time, open up real estate investing to a much broader class of investors, folks that either don't have the capital to buy an asset outright, don't have the time to become a landlord, but want exposure to the asset class and want to do it passively. So our initial concept was really to create efficiency, transparency, access for both investors and operators that didn't exist before in the offline world. Over the last, 24 to 36 months, our vision has gotten a lot broader and a lot more grandiose, which often happens with a company. When you first start, you're just trying to solve a simple problem. That problem could be something you're suffering on your own. It could be a problem that, a lot of potential customers are suffering. But over time, the idea can become a lot bigger because you realize the potential is a lot greater than what you initially created the company for. So our vision, Mitchell, is to really create a global platform for online real estate investing, essentially a global marketplace, almost like the stock market, where you have investors in markets all across the world, U.S., the U.K., China, Asia, LATAM, anywhere you have, a demand for real estate investing, you have a potential customer. And at the same time, take our focus and our footprint where today it's only projects in the U.S., real estate projects in the U.S., and also transform that into a global market where we're able to finance projects no matter where the project may be located. And at the same time that we have this global marketplace, we also have secondary liquidity. We have a secondary market. We're able to transform an illiquid asset into something much more liquid. And that's what we call our 10-year vision, our 10-year plan. We know it's going to take a lot of work, a lot of capital, a lot of great people in the company, and a lot of grit to get there. But that's really where we ultimately want to be. We want to transform this real estate market that's been illiquid, it's been capital intensive, difficult to access, into something that's liquid, efficient, transparent, and almost create a global stock market of sorts for the private real estate market. So that's what we're gearing towards. I mean, right now I would say we're in inning one. We're still very early stages. We're only in the U.S. today. We have thousands of investors from almost every state in the U.S. using us, but we're only a fraction of the investing public. So there's still a long ways to go, but we're very motivated and passionate to get there. And every single day we're impacting customers, and that's what keeps us excited as a group of individuals and entrepreneurs that can't wait to continue innovating in this massive market.
Well, I'll tell you what, I was excited before having you on the show. I am so pumped right now because what you're really talking about is an actual exchange. I mean, when we're talking about online real estate investing, we're not just measuring it in millions or billions. We're talking about trillions of dollars. So when you want to create an exchange like we're talking about, like, where do you even start, Nav?
Yeah, so the first, and you're absolutely right. One of the things you struggle with when you're a founder of a company is what do you focus on today? I mean, a lot of entrepreneurs, I think, try to do too many things at once, and one of the most important things about a startup is focus. So you need to have a narrow focus, a singular focus. I mean, look at all the very successful companies out there that are now billion-dollar enterprises. Let's take a few: Airbnb, Facebook. They all started with a very specific focus. Facebook was, we want to create a social network for students at Harvard. They have to have an harvard.edu email, and that's what we're catering to. And that obviously has become a global social network that's much bigger than their initial vision. Airbnb, they just wanted to provide, create extra income for themselves by renting out their futons and their air mattresses. And now it's one of the most largest global travel companies in the world. So even at Realty Shares, our singular focus in the beginning, and it still is true today, has been access to capital and quality real estate deals for investors in the U.S. That's our singular focus.
We have many different sponsors. One of our sponsors is hosting. So when people go over to mitchellchadro.com/hosting, they can see all the different hosting companies that our guests actually utilize for their own companies as well as the ones that they invest in. Is there one or two that you can sort of recommend? And I'll be sure to link up to that as well.
In terms of hosting service, I mean, we've always, when I bought domains, I've always used GoDaddy, but I think hosting AWS, Amazon Web Services, cloud-based, it's the future. That's what we use at Realty Shares. So I would say that's the place to go if you're looking for hosting on the cloud. And now it's much cheaper to host on the cloud than it is to host in a physical server, as we all know.
Perfect. Our startup round. Students, business owners, those individuals out there who want to start up something new, they need a presence online, and they need a web hosting company that they can trust and they can count on, and that's reliable and helpful. So what did I do? I teamed up with the good folks at Hosting, where they offer my podcast audience 25% off their web hosting package. Check them out at mitchellchadro.com/hosting. That's mitchellchadro.com/hosting. Start your plan today.
So the first inning, the first phase, Mitchell, is really to create access where it didn't exist before. Access to investments for investors, access to capital for entrepreneurs and developers. And before we can create that global marketplace, we need to get that right. We need to get that very, very right and have a brand that people when you think about our brand, people think access, people think efficiency, people think transparency. From there, we will need to build a lot more technology. I mean, creating an exchange in real time, a secondary market, requires a lot more technology build out. It requires a lot more regulatory know-how. So that's still, I would say a year at least, maybe 2 years away. But the first thing we have to get right is that initial access and transparency and trust that you have to have before you can create anything that resembles a global marketplace that has instant liquidity.
Yeah. You know, you mentioned Airbnb, and that kind of reminds me, early in your finance career, you actually got to not only do a project with Airbnb's headquarters, but also Pinterest's corporate offices, and ironically, both there in your hometown of San Francisco and on the same street south of Market. Can you talk to us a little bit about those earlier beginnings?
Absolutely. So when I graduated from law school in 2010, I worked for a firm in San Francisco, law firm called Perella, Braun and Martell, and I was specifically in two different areas of law practice. I was in the land use practice as well as the transactional real estate practice. So I got to work on a wide swath of different deals, and it was really exciting because at Perella, it's a smaller firm. You get very close to the project very early on. So the half of my practice was really focused on helping large developers and property owners acquire new properties, lease those properties, and potentially even raise capital for new projects. And the other half of my transactional practice was solar development. So I represented First Solar, a public company, and helped them put together land rights for two of the largest utility scale solar projects in California. Combined, it was like an 800 megawatt project across two different sites. Then the other part of my practice is land use and development. That's where I got to work with large REITs like Archstone, Avalon Bay, Equity Residential, and in that capacity, I helped them entitle over 1,500 units in San Francisco, South of Market, and Potrero Hill area, and also over 300,000 square feet of retail and office. And then I also worked with innovative office development companies. And as anyone that's lived in San Francisco or tried to develop anything in San Francisco knows, it's very, very hard. It can take 5, 10, 15 years, many lawsuits before your project's finally approved and before you put a single stick in the ground for construction. And San Francisco was trying to encourage more office projects to be located in the city boundaries because they had lost a lot of office through the passage of a proposition back in the late 90s when a lot of office tenants left San Francisco because it was too expensive. So they were trying to encourage office space to come back. And what they did was they took historical buildings and they told developers, as long as you preserve the historical nature of these buildings, we're going to let you convert industrial space into office space. And so what I was able to do is help these large developers take those new ordinances within the land use law and utilize them to basically convert industrial space, which is obviously a lot less on a price per foot basis from a rent perspective than office, and convert it to office. And I got to do that for a developer that leased a large part of their building to Airbnb, and then another developer on the same street, a different developer, that got to lease it to Pinterest. So it was really exciting because you were seeing startups growing. You were seeing a lot of startups relocate into San Francisco rather than Palo Alto and Mountain View, and the city was actually for all this relocation because they know it meant creating a lot more commerce within their city boundaries, commerce that they lost back in the 90s.
Well, I know you mentioned Avalon Bay, and not only on the East Coast, but most people are not aware that they also had commercial properties in Southern and Northern California as well. But didn't you also work with Sam Zell's REIT as well?
I did, Equity Residential. So that kind of happened almost by accident. So we represented a private REIT called Archstone. I mean, if you've been in major cities like San Francisco, LA, New York, you'll see Archstone projects all around those markets. It was one of the largest private REITs for apartments out there. Back in 2000, I believe it was 12, if I have my dates correct, Archstone actually sold off all their assets to two different public REITs. One was Avalon Bay, and the other was Equity Residential, and that's Sam Zell's residential REIT. And as such, we took over, Equity Residential took over all the projects that Archstone was doing. We represented Archstone. So then we started representing Equity Residential on those very same projects. And obviously Sam Zell is one of the savviest investors out there when it comes to real estate. He's made billions. He's very smart. He knows when the market's going to turn. He knows when to buy. I mean, he's really the godfather of real estate investing and development. I had never personally met him, but I know a lot about him just through my readings. And you know what's interesting, Mitchell, is he was quoted about a year and a half ago or 2 years ago saying, I'm getting out of all the major markets like San Francisco, New York, where we've seen cap rates get to 3-4%. And he's starting to buy things in secondary markets like Toledo, Columbus, et cetera. And, at Realty Shares, what we focus on, our bread and butter is secondary markets. We're not big enough to provide capital for deals in San Francisco and New York where you can often need $50 or $100 million for a single project. Our bread and butter is providing $3 to $7 million in equity or up to $10 to $20 million of debt. And so we tend to focus on secondary markets. And it feels really good to hear Sam Zell say that's also where he's focused, because that's been our strategy from the very beginning.
The reason why I chose books to sponsor my fast pitch round, that's easy. I love books, and books is owned by a powerful company that stands behind all their products, was willing to offer an exclusive free 30-day trial to my podcast listeners with one free audiobook download. If any listener doesn't like their books, exchange it, and you can cancel at any time. Keep your free download, and you can choose from over 180,000 bestsellers, new releases, classics, and more. I recommend The Last Lecture by Randy Posh. So dream big, get inspired, and listen up. Go on over to mitchellchadro.com/books. Again, head on over to mitchellchadro.com/books. It's your number one resource for books. Can you recommend a book? I love books. I'm sure you like to read as well. Can you recommend just one book to the audience that you've gotten the most out of?
Yeah, there's 2 books. Can I say 2, Mitchell? Or
Go for it.
Okay. So
for good friends like you, yes, absolutely. 2 is a must.
Well, these are 2 books I require everyone joining Realty Shares to read, because I just think they're amazing knowledge centers. The first is The Hard Thing About Hard Things. It's a book written by Ben Horowitz. He is one of the founders of Andreessen Horowitz, one of the most successful venture firms out there. And this book talks about his journey building a company, the ups, the downs, the near-death experiences from a company perspective that he experienced. And the reason I love it is it tells you all the non-glamorous elements of building a venture-backed business, the stress, the sleepless nights, the almost failures. It's one of the most amazing books to give you context on what can go wrong with your company and what to do when everything goes wrong. So I recommend that to anybody building a business, and I recommend you reading it every year, because you're going to learn something new every year, because your company's going to change. Some things that were irrelevant a year ago are going to become relevant in the next year. Your company may be going through some turmoil, and you're going to want to reread a chapter. It's the best.
And that's how you know it's an awesome book, when you want to go back and you want to reread it again and again and again. So that's an awesome tip. And what's book number 2?
So book number 2 is How to Win Friends and Influence People. So in the Valley, people undervalue EQ and overvalue IQ. It's all about how smart you are. What school did you go to? What company did you work at? Did you work at Google and Facebook? We want you. And that's great. You need smart people to build a successful company. But too many companies undervalue EQ, how well you work with others, how you collaborate. Not just how big your ego is, which is something you want to avoid, but how you can put your ego aside for the success of the company. And it's so darn important to have a company with people with high EQ, because otherwise your company will fail. And if you think about it, let me give you an example, Mitchell. So back in the heyday of 2 companies, I'm going to name 2 names that people probably know, Zynga and Trulia. Zynga, in the heyday, it was all about hiring smart people, treating them in a pretty awful manner, but they had, they were doing so well, no one wanted to leave. They were having happy hours every other day. They were throwing these massive holiday parties, and it was great. You had these mercenaries that were there because they knew the company was doing well, and they knew that they were going to have these glamorous parties. Then you had Trulia. None of the glam, treated the company, the people really well, didn't have these, did well, didn't grow as fast as Zynga, but did well. Obviously, he's done really well now. And when shit hit the fan, meaning when the companies were going through when we were going through the Great Recession, Zynga lost a lot of talent, because those people were there. They were getting paid well. They were having these parties, but they were treated so awfully that when things got bad for the company, they were quick to leave. Trulia retained almost all of their talent, even when the company started hitting some road bumps, because their culture was built on EQ and taking care of their people. So it's so important to build that into your culture. And the reason I love this book, How to Win Friends and Influence People, is it's literally a people Bible. It tells you how to work with people, how to help them get what they need to get done before you think about what you need to get done, and how that'll come full cycle. It's, again, something that you should have close to your desk, and you should reread it anytime you have a conflict, anytime you're trying to think about how to deal with a new coworker or a difficult situation. It tells you how to deal with people in a way that, no other book has, at least from my experience.
And Nav, that's why you're the triple threat. You have all three. You've got the IQ, the EQ, and the AQ. We were just talking about that on show 055 with Ron Suber. So people are going to be able to go back and listen to that just to kind of, get back into all of those three things. Well, we're going to certainly cover exactly, who your customer is and how you actually help the consumer. But before we do that, why don't we go a little bit broader, and now why don't we talk a little bit about simply explaining what is real estate crowdfunding and actually how it works?
Sure. So real estate crowdfunding is a bit of a misnomer, Mitchell. And crowdfunding really got its start, and you probably know this from your prior podcast, within the donation and rewards-based world. I mean, Kickstarter, Indiegogo, helping people put small amounts to work into interesting projects, interesting services, interesting products, and in exchange for that, getting early access to that product. So there wasn't no actual investing activity happening, but there was this concept of grouping money together through a bunch of individuals to help fund something like a project or a product. Crowdfunding then kind of expanded via the Jobs Act back in 2012 into things like helping fund startups, helping fund consumer companies, and helping fund real estate. And that's really what we do at Realty Shares. But interestingly enough, most platforms out there, including Realty Shares, don't really cater yet to non-accredited retail investors. Most investors on our platform are either individual accredited high net worth investors or institutions. So crowdfunding is a bit of a misnomer because it really implies anybody, no matter who you are, no matter what your net worth, you can participate, group your money with others like you, and take down projects, whether they be in real estate or something totally different. But it's easy to reference this as crowdfunding because the concept is the same. And what we do at Realty Shares is we give individual investors, institutions access to real estate properties around the country. As you mentioned, we've done deals in 39 states. We've worked with hundreds of different developers, thousands of different investors, and we've helped those investors group capital together and put that capital to work in these very interesting private real estate projects. And the beauty of being able to do this through the internet is, one, you create access where it didn't exist before. You remove that barrier to entry because now, even if you live in California, you can participate in projects in Texas or Florida from the convenience of your laptop or tablet while you're sitting in your living room or you're sitting on a beach. So that nexus to the market doesn't need to exist anymore through this concept of crowdfunding. The second thing we're able to do by utilizing technology is drastically reduce the minimums that you have to put to work into a single project. Historically, if you were buying an asset outright or you're participating in a private partnership, you would have to put at least $100,000 to participate. And our platform gives you access to private real estate deals for as little as $5,000. So that means instead of putting $100,000 in one single concentrated project, you can put in 20 different deals to our platform. And the last thing we've done is we've changed the mundane, arcane process of signing documents offline, working with escrows, et cetera, which could take a process and make it 2, 3, 4 weeks or even months and transform it into a digital process that takes all but a few minutes to complete. So really, we haven't changed the typical way of fundraising or how it's structured, the legal processes. That all still remains intact. All we've done is take the process of syndicating and accumulating capital and putting it to work into a project and made it much more efficient and digital, which saves a lot of time, saves a lot of money, and we pass those savings on to our end customers.
So I know that Realty Shares is not exactly real estate crowdfunding, as you just indicated, because you're not geared towards the retail market. I would say it's closer to Prosper, but for real estate investing, but you don't focus on the retail consumer market, but just the accredited investors who want to bank smarter. So let's explore Reg A+ and expanding the retail market.
Yeah.
What are you going to do in the future to start moving in that direction?
Yeah, so this gets back to our 10-year vision. So our 10-year
Correct.
vision is a platform that caters.
You knew I was going to circle back around to that, right?
I know, and you're a smart interviewer. I knew you were getting there. So our grandiose 10-year vision includes a global market. And you don't have a global market when you're excluding 90% of the population from your platform. So the ultimate goal for Realty Shares is to get to a place where we can cater to any investor, whether they're institutions, RIAs, accredited investors, non-accredited individuals. Our vision is only realized once we're able to access all those different investor types and provide them with an efficient digital solution as well as a secondary liquidity market. So, Reg A+, I'm glad you brought that up. It's part of the Jobs Act. It was Title IV. A lot of people thought Title III would be the way that retail investors participated, but I won't get into details here. It's riddled with complexity and limitations that I don't think is going to make it widely utilized across platforms like Realty Shares. But Reg A+ is interesting because Reg A+ essentially allows you to raise $50 million a year. So you can raise $50 million in 2017 with the same REIT offering or the same Reg A+ offering, another $50 million in 2018, 2019, et cetera. And you could do it through retail, non-accreds, as well as accreds. And it takes about 3 to 4 months to get that Reg A+ offering approved. The second or third time around, it should be even shorter. And you can raise it in a fund-type structure. So there are some early adopters of this Reg A+. If you look at Realty Mogul or Fundrise, two of our competitors, they have started utilizing this Reg A+ to create these E-REITs and raise capital, $20, $30, $40 million to a broad swath of retail, non-accreds, and accreds. So that
and it's also actually reduced minimums as well.
Exactly. So you're seeing minimums as little as $500 to $1,000 via these private digital REITs versus the $5,000 we were seeing with accredited investors. So I think it's a very interesting place for us to go, Mitchell. But I go back to what I said earlier. So I'm also going to play this whole go back to what I said earlier game that I know you're going to be playing through the podcast, which is focus. Focus is critical for the success of any startup. So our focus has been we need to create a liquid marketplace, and today we're singularly focused on institutions and accredited individuals. Retail investors are definitely part of our long-term plan, and I can't tell you whether that's going to be 2018 or 2019 or 2020. I don't think it'll be past 2020, but we will have retail investors participating through our marketplace, likely through a Reg A+ offering within the next 3 to 4 years, because that is the only way to realize our full vision of creating a global liquid marketplace for the private real estate market.
A lot of people talk about real estate investing. Let's switch to passive income, which is really what Realty Shares is helping their audience do. So obviously some investors are risk adverse, for example. They need passive income. They don't want to have low yielding bonds. They don't want to deal with traditional bank products. They don't want to be a landlord, for example, and having to deal with the maintenance. Talk to us a little bit about passive income versus active, real estate investing and the pros and the cons there in terms of what you can afford people that going more active might not.
Yeah, it's a great question. So, there's a lot of great operators and developers of real estate out there. I mean, I've invested in my own capacity. They're ones that may be doing this as their sole job. They're professionals. They've been doing it for 10 years. And they want to be active. They make money being active. They're vertically integrated oftentimes. So that's one class of investor. But that takes a lot of time. It takes a lot of knowledge. You're a landlord. You're dealing with tenants. You're dealing with toilets and trash and all the stuff that goes along with being a landlord. And they love doing it because that is their job. And then a lot more investors or potential investors that may be investing in stocks and bonds, and maybe they're professionals, maybe they're doctors, maybe they're lawyers, accountants, et cetera. Maybe they're finance professionals, and they love the concept of investing in real estate, but they don't want to be a landlord. They don't have the time, the know-how, the knowledge, whatever the limitation, they don't want to become landlords. So, historically, there were a few ways to participate in real estate before the creation of platforms like Realty Shares. One was go buy an asset outright, go buy that apartment building, go buy that retail property, and become a landlord, meaning you're spending a disproportionate amount of your time dealing with rent, dealing with leases, dealing with tenants. Number two was go buy into a public REIT. That's a great way to participate if you want exposure to real estate, if you want a liquid investment. But public REIT and direct investing are very different from a correlation to the stock market perspective, from a yield perspective. So it's really two different types of real estate investments. And the third option was these country club syndications where you put in $100,000, $150,000, you get a stake in an LLC or a limited partnership, and all of your risk is concentrated in one single property with one single developer. So that's the old model, and that's kind of what existed to you before. The only methods that I've named that were passive were the REIT or the private syndication. So we're not changing how the private partnership model works. All we're doing is taking that same passive model and bringing it to the digital world, which means lower minimums and much more diversified access that's no longer limited by geography and where you live. And so what that means is you can buy $5,000 stakes in these properties all over the country, and you're still doing it passively. You're getting an income stream every month, every quarter, but you're not dealing with any of the operational headache that comes with being a landlord in commercial real estate. That's the beauty of our platform.
Let me be fair and balanced for the audience out there. You had mentioned the key word being illiquid. So some of the listeners out there would just ask, okay, why not just buy a publicly traded REIT or fund, which is obviously incredibly liquid? Can you address that for those who are basically thinking that right now?
Absolutely. So public REITs are great investments. I mean, whether you're investing in the equity REITs or the mortgage REITs, which tend to have a bit more risk, REITs have outperformed the stock market S&P over the last 10 to 15 years. So they are a good investment, especially if you're looking for something very liquid, something you could trade in and out of on a whim. But you're also limited with REITs in a few ways. One, REITs tend to have a little lower leverage than private real estate. That's mandated by their charters. And what that means is your yields are going to be half of what you can get in a private real estate deal. So instead of a 6 or 7% cash-on-cash return, which we're often seeing with deals on Realty Shares or higher, you're going to be getting a 3% yield or dividend on an equity REIT. So one is just you're paying for that liquidity. You're getting an illiquidity premium in private real estate that you're not getting in liquid REIT real estate. Two is a lot of investors want to see, touch, feel, even if it's digitally, the real estate deal they're investing in. And at Realty Shares, we provide pictures, we provide property information, we provide drone flyovers. So you're getting a lot more nexus and transparency into exactly what you're investing in. Whereas with public REITs, you're really investing in an entity that's then putting your money to work into different deals. And so it's much more of a fund structure than a direct real estate investing structure. So if you're looking for more control, the private real estate deals is really going to be the better bet. But, Mitchell, I go back to what I've always believed as an active investor and as the founder and prior CEO of Realty Shares, which is successful real estate investing successful investing, period, is all about diversification. You look at the two of the most successful institutional investors in the world, the Yale and Harvard endowments, they have 20% of their portfolio in real estate. They have money in timber and equities and global equities and domestic equities. And they do that because they know the best risk-adjusted returns are going to come through a truly diversified portfolio. But individual investors have not had the same luxury of diversifying their portfolios. They put money into what's easy, public equities, bonds, or REITs. And now they finally have an opportunity to efficiently invest in private real estate. And I encourage investors to put money across a diversified pool of assets. And public REITs and private real estate are not mutually exclusive investments. You actually will perform better, and we've seen a lot of different research around this. If your portfolio has both, versus if you just have one or the other. So that's what I love is diversified investing, and that's what I encourage our customers or our prospective customers and your listeners to be thinking to do.
Well, you talk about the consumers out there's diversification. Let's take a look at your own diversification. Back in the day, Lending Club obviously did that very well with the capital sources, when they kind of moved to pensions and institutions and family offices and registered investment advisors. So in terms of Realty Shares, I know that, you first did this in New York, when you brought on your first hedge fund, for example. So how are you broadening your own investor base?
Yeah. So, this goes back to one of the questions you brought about, having an interim CEO and Ed Force. One of the reasons, Ed is so exciting is his entire career has been in capital markets. So at Goldman, where he was the chief administrative officer overseeing Goldman's technology team, overseeing the asset management division, the risk division. He was dealing with a lot of different capital sources, and that's something that really intrigued me about his background. Because our focus, Mitchell, and this started in 2016 with the creation of our capital markets team, was to do exactly what we saw happening in the consumer lending market, which is diversify our platform with respect to liquidity, bring more liquidity to the market. And that really included broadening our capital from individuals to institutions. So over the next 12 months, we're going to continue that trend. We've done really well as a platform in terms of underlying performance of our assets. So that opens up the doors to larger institutional, more sophisticated investors. And today we work with hedge funds, we work with private equity firms, we work with insurance companies. So we're already seeing. Can
you tell us a few that you actually work with, and who's your top 10 list going down the road? I mean, in terms of who you'd like to focus on.
Unfortunately, now that I'm no longer CEO, I probably would even get more trouble by mentioning these names.
Nav, we're like the best of friends here. I would never. It's just you and I talking. I would never do that to you. You know what I mean? Because I really like you.
Mitchell, as much.
Can you throw us? I'll tell you what. Can you tell us one or two or three?
Sure. So, one of the firms we've worked with since the very beginning is Napier Park. They're a $5 billion hedge fund out of New York. I don't think they would mind me saying their name, but they're getting pretty active in the online investing world. I won't name any others just because of the confidence.
I'll have a link back to them.
Hey, look, hedge funds didn't become successful by turning down capital, so you never know. Napier Park was a great early partner for us. They've been great to work with. And we have a lot of others like them, as well as others that are non-hedge funds. So it's been exciting. I mean, expanding to institutional capital, the reason that's been exciting is it just brings a lot more capital to the platform quickly, which means we have more capital to deploy into these very interesting projects and provide a very value-add service to our developers and operators. And it also validates our platform. I mean, institutional investors take months, if not a year or more, to do their diligence. If they approve you, they give you the rubber stamp, that means they've done a lot of diligence, which also helps individual investors get comfortable with the diligence and curation in our processes that we've really honed in on at Realty Shares.
The show is called Listen Up because I do a lot of talking, so every once in a while I'm really listening closely to the guest. And earlier I heard you mention two competitors, which I thought was very telling in the sense that, you're not shy of mentioning who your competitors are because, cream always rises to the top. Now, you had mentioned Fundrise, which actually got started maybe a year before you did back in 2012. And at that time, when you were looking at it, you probably thought, gee, there's a lot of barriers to entry. And I'm sure Fundrise and some of the other competitors were hoping and praying that the barriers to entry were such that a lot of people would throw up their hands and say, gee, I'm not going to deal with this. So, for example, you had to deal with the Securities Exchange Commission with investments. You had to deal with the banking department with lending. You had to deal with compliance issues and things that are dealing with accredited investors. So most, like I said before, would just probably, become so overwhelmed with that. How did you actually overcome that and actually start to deal with it? Because, there's a lot of businesses out there that are also dealing with barriers to entry with, with companies that are entrenched in the market, and they want to know how they can actually get started. So how are you able to deal with that?
Yeah, I mean, you're absolutely right. And going back to your point about mentioning competitors, this is such a blue ocean nascent opportunity, and you have to, whether it's us, Realty Mogul Fundrise, we're all trying to pioneer a new industry. So I don't really shy away at all from mentioning competitors because I have a lot of respect for my competition. It also keeps me on my toes. I mean, if we're in a market where we're the only ones, either we're in the wrong market or it doesn't give you the same motivation to continue getting better and better and better and beating your competitors. And I'm a very competitive guy myself. And quite frankly, I really consider them, co-collaborators in educating the market on what we do exactly. So I think that's very important to think about your competitors almost as cooperators, especially in the early days when you're trying to create a new industry. But, the barriers to entry, you're exactly right. And the interesting thing about fintech that you don't deal with if you're starting a consumer tech company, for example, Facebook didn't have to really deal with this. Airbnb had to deal with a lot of local restrictions, but that's much easier because your customers are local. And as long as you can get those customers behind you, you're usually going to be able to sway the local legislator to move in your direction. But dealing with federal government, state government, it's a lot trickier. You're a lot more removed from those government constituencies than you are when you're dealing with the local government. So, I wrote a TechCrunch article, in case your listeners want to read it, called Fintech Startups Navigate Legal Gray Areas to Build Billion-Dollar Companies. And I wrote this back in 2015 to talk about exactly what you mentioned, that with fintech, with regulated industries in the tech space, you have a lot more to worry about than just the typical things like growth, venture capital, unit economics. You're dealing with regulators, you're dealing with the SEC, with FINRA, and you have very little room to screw that up because a single failure can lead to the demise of your company. And I don't know if Ron Huber mentioned this, but before he joined Prosper, when it was still under the old leadership, back in 2008, the SEC actually issued a cease and desist to Prosper because it argued that what it was doing was not securities. And that basically set Prosper back at least a year and a half. And that's what allowed Lending Club to take the lead as being the leader in that space, which is a lead they've maintained ever since. So it's very important to understand the nuances, and I say this to your listeners, of your specific industry. But I also think that represents opportunity because not everyone is going to have the stomach to say, not only am I going to build this very risky, high-growth startup and have to raise a lot of money and worry about all the technology elements, but I'm also going to have to navigate very detailed, intricate laws that haven't really changed in decades to build a company. And so I do think that provides a little bit of a competitive advantage that's allowed Realty Shares and others like us to build bigger businesses while others have struggled to enter the market.
Well, like Ron is doing in the peer-to-peer lending, it's exactly what you're doing in the real estate investing market. You are inspiring collaboration. I mean, your approach to competitors and the way that you view them, I think, is very refreshing. How is real estate right now?
So I think real estate is definitely in a much different place than it was in 2012. It is definitely frothy in a lot of places. So if you look at markets like the coastal markets, if you look at markets in, like Miami or San Francisco or even Oakland, parts of New York, et cetera, you are seeing cap rates go to a level that I'm a little uncomfortable with. You're seeing a lot of high-priced for buy and for rent real estate. But those markets also have a ton of demand. I mean, supply and demand is always going to favor the demand side because there's so much demand to live in those markets. And, a lot of the secondary markets adjacent to those markets start benefiting from that demand. Like you've seen Brooklyn and Queens and Oakland benefit from high-priced real estate for appreciation because you've had a lot of flow out from San Francisco, New York, and Manhattan, which gotten insanely expensive into these smaller secondary markets. But I'm still a big believer that there's a lot of opportunity in real estate, and that opportunity is in secondary markets like Austin or Dallas instead of New York or San Francisco. So I still think we have strong fundamentals in secondary markets where you haven't seen as much cap rate compression, you haven't seen as much new supply come on board, So there's still a lot of opportunities to buy right. But I do think we're going to see some change in the market. We've already seen it in the core urban market, where in San Francisco 2 years ago, you'd put a condo on the market, you have 10 offers, 30, 40, 50% above ask. That's changed. You're seeing rent stabilize more. So you're already starting to see that frothiness start to correct. But I think we may see a larger correction in 2019. Now, don't get me wrong, it's not going to be anything close to what we saw in 2007. We just haven't seen as much loose lending in the market as well as new supply, but you may see an impact to prices, whether it's for apartments or retail or office rent that you haven't seen over the last 7-10 years. And so we've been in a pretty long up cycle. It's been 10 years. And so we're due for some sort of correction. And I think 2019 may bring some level of correction. We're also seeing rates go up. Like the Fed said they're going to raise rates 3 times in 2018. That'll make debt more expensive, which can also impact how many buyers there are out there for commercial real estate. So that's kind of my high-level take on the market and where it's going.
No, that's great. I wanted to give the listeners a broad understanding of where things are today. I was so impressed when I looked at your ability to do your own fundraising for Realty Shares. Let me just give a quick brief overview, and then I want to ask a question that could actually help our listeners. So you actually raised one of your first seed rounds for $2 million with General Catalyst out in Boston with that venture capital firm, and of course they've invested in Airbnb, we've talked about in Kayak, and then you went to Manlow Ventures and raised $10 million, and then in your next round, $20 million with Union Square Ventures. So can you give some practical tips on some of the audience members out there that are growing their business, taking their business to the next level? I even have one past guest who's going to actually be on Shark Tank on January 7th. So that's really exciting, a company called Detrapel. So can you talk to the audience a little bit about what it takes to raise money from those types of venture capital firms?
Yeah, so we can have a whole hour-long conversation, Mitchell, on just this topic.
And we're going to have you back. I mean, this is actually could easily go into our second hour, and we're less than an hour show, so we're really excited. There's a lot to cover, and I wanted to make sure to give the audience as much information and for them to learn as much about you as possible.
Absolutely. Well, definitely. Anytime you want me back, I'll be back. But so it's interesting. Raising capital, first and foremost, it's not for every type of business. So venture capital is when you're raising venture capital, you're signing up for a very specific type of company that you're going to have to build. Venture capital is in the business of they want to put money in on big bets. They want companies that are going to 10x at least, if not more. They want companies that are going to exit within a 5 or 7 year time period. Most venture funds are 10-year funds. So a company's out there for longer than 10 years, venture capitalists are going to start getting antsy. So you're basically saying, once you've raised venture capital, I'm going to be focused on growth almost above everything else. And if your business is not going to grow at least a doubling of every year, do not raise venture capital. And not every business should or can grow at that rate. So if you're building something that, you're content growing 10% a year or 20% a year, and you're going to be able to make money, and you're not going to have to burn a lot of cash, and you're not going to have to grow at the risk of destabilizing your company, do not raise a single dollar of venture capital. So I want to give that disclaimer right off the bat, because people think venture capital is this glamorous, amazing type of capital. Every business needs to raise it. That's simply not true. Now that said, venture capital, especially from top-tier investors, can set your company up for success because it gives you capital to build a company quickly, to keep competitors at bay. So it's something that could be really good for companies that know they're going to grow fast and where there may be some competition. And it's really, really hard. Raising capital, whether you're raising it for real estate, for a hedge fund, or from venture capital, it's hard. It takes grit. It takes perseverance. It takes a lot of tenacity, because you're going to get a lot of people that tell you no. They're going to say no because they don't like your idea. They're going to say no because you think you're too early. They're going to say no because there's too much competition. The single most important piece of advice I can give to anyone looking to raise venture capital is it only takes one yes. You can have 100 no's, as long as you have one yes, that's all you need. So don't be discouraged by people telling you no, because you're going to get no. Unless you're Facebook back in 2007, you're going to get no. That's just part of the bargain of raising venture capital. The second thing I'll say is consistently get better. After every no, find out why they said no and address that in your next pitch. Because again, if you're not getting better, then you're going to get no's across the board. Make sure you're continuing to hone your pitch, making it better, practice it in front of your coworkers, practice it in front of your spouse, practice it in front of the mirror, whatever you got to do, make sure that pitch is very, very compelling. So those are two very important pieces of advice. And my first experience at raising money, yes, we've been able to now raise $60 million of venture capital in 3 years. But my first set of experiences were people laughing me out of the room. When I was pitched my idea telling me, you're going to get sued, this is never going to take off, I got a lot of no's. And those early no's are very, very discouraging and also almost derailed me. But then someone told me, I was talking to a friend, and I still remember this piece of advice, and they said, don't quit. Keep going, have perseverance, have grit. And honestly, that's helped me drive the company Realty Shares to where it is today, because I've had a tenacity and grit that I formed very early on through a lot of rejection, through a lot of failure. And you have to have that to build a successful company.
Listen up, trusted friends, because there was a lot of value bombs in what Nav just told all of us. Graphic designer sponsors the wrap-up round. I needed help with my graphics for all my social media. So if you head on over to mitchellchadro.com/graphic designer, is there someone else that you can recommend in terms of a graphic designer for the audience?
I've worked with a individual named Josh Prince, P-R-I-N-C-I. We had to do a logo redesign. Our logo has changed once in our future. I love our logo now. Josh helped us with the logo redesign. He helped us with the first mock-ups for our very first iteration of our website. Very, very talented designer. And now he works at a firm called Onyx. He's one of a few members of Onyx. And Onyx is OYNX. But I love Josh's work. He's fantastic. I would highly recommend him.
That's great. And, you know, we've talked about so many different resources because we're really big on resources for entrepreneurs out there and also for investors. And so I'm actually going to have not only all the notes for today's show, but any links to any of the companies that we've actually talked about. And they'll actually be able to find that back at mitchellchadro.com/show056. So this is really excellent. We're all about entrepreneurship here on the Listen Up Show. You can get the show notes at mitchellchadro.com/show056. Can you leave us with three main takeaways? You've given us so much wisdom. We really appreciate all of the time that you've given to us and the audience. But just to sum it up, three main takeaways.
Yeah, definitely. I have 100 bugs. I'll sum it up.
Yes, no, I'm sure, and that's why we're going to have you back on.
All right, perfect. So one is it's a marathon, not a sprint. When you're building a company, you have to remember there's going to be ups, there's going to be downs, and a company takes potentially 5, 10, 20 years to create, and that means you're going to have a lot. You're going to have a lot of grit. You're going to have the perseverance, and you can't just think about a company being a 2-year thing. It's going to take a lot of your time and your energy. So don't burn out. Take time to vacation. Take time to self-reflect, because it's very important to the success of your company that you stay healthy. You stay healthy mind, healthy body, because if you're not healthy as the leader, the CEO, then the company's not going to do well. A second key takeaway that I think it cannot be understated is you cannot be successful without hiring really good people. And I go back to both IQ and EQ. A company is only as good as the last person it hired. So you have to spend a lot of time on who you're hiring, setting the right culture, treating them well, making sure you're retaining talent. It's much more expensive to lose a really good team member than it is to hire a team member. So, you know, once you hire the person, that's not when your job ends. You got to retain them. You've got to make them feel wanted. You've got to make them feel like they're part of something big. They're part of something. They're part of a mission, a vision, and that's a very important part of building the right company. So I think that's something that can't be understated. Third thing I'll say, and this kind of is related to number one, which is it's a marathon, not a sprint. But one thing I really found helpful is every month I take 2 days out of the office to just think about the forest from the trees. And I think, again, I mentioned this when we first started. One thing that's interesting about my new role is I'm actually able to view the company from outside, which could give me a lot broader context than just the day-to-day I was getting as CEO. So I think just taking time, leaving the office, maybe it's on a long-haul plane ride, maybe you're just leaving, you're going to a cabin. That time sometimes is not only the most effective time to think and innovate and think about the next phase of the company, but it also gives you much needed mind space that I think is very key to building a successful company.
I have really thoroughly enjoyed this interview with you, and I am walking away knowing you, feeling like I know you a whole lot better. And we've talked a lot about some fun facts about Nav here in closing. One of the ones that I thought was the most fun that I have found, and I wanted to kind of end on this because as we go into the new year, focus on our businesses, we focus on our family and our life. I think this kind of maybe sums it up. You actually, with your family, you actually grew up in California's Central Valley, and the family actually had an almond orchard, and you probably learned a lot about life and business and family right there on that family's almond orchard. Can you tell us just a little bit about that here in closing?
Yeah, you definitely have gotten to know me through my past podcasts and interviews. So I love how thorough you are. Well, thanks, Mitchell. I appreciate that. So, I grew up in a family where my parents were immigrants. They moved over from India when they were in their early 20s. They had nothing really in their name. They had maybe a handful of dollars, and what they saw is this massive opportunity in this country where you can live the American dream. And so they worked hard. They worked odd end jobs. They had 2 jobs. I remember my father telling me he was going to school and he had 2 jobs for about 4 years. I was like, wow, I can't imagine how you did that. I mean, it was hard enough just to do Realty Shares and the law firm job. And some of these jobs were hard. I mean, these were working on farms. These were manual labor jobs, not a cushy office job. So I learned a lot about hard work, tenacity, perseverance from my parents. And I always tell people, I've never been the smartest guy in a room. Like, there's always going to be someone smarter than me, but I've been the hardest working. I'll work harder than anyone in the room and be more successful because hard work goes a lot further than just being smart. So I learned a lot about hard work. I learned a lot about the ups and downs of business, a lot about innovation, and a lot about just values from my parents and the experience of growing up on an almond farm and seeing my father take, 2 jobs and going to school and turn it into a very successful enterprise. So I'm humbled by just what they've accomplished, and I owe a lot of my success to just learning from watching them and watching them go through the hardships, but also the successes they've had.
Nav, we're all going to be keeping in contact with you. What's the best way?
So my RealtyShares.com, that's definitely where you want to go if you want to learn more about us there. My personal email is nav@RealtyShares.com. I still have an active email as a board member, so you can reach me there. I know on your website you've included my LinkedIn and my Twitter handle, which I really appreciate. So please, any listener, if you want to reach out to me on Twitter, on LinkedIn, I'd love to hear from you.
Nav, this has been really terrific. We want to thank you so very much. As I said before, I have thoroughly enjoyed it. I know the audience has as well, and I know that we're going to be in touch real soon because, we'll have you back. There's so much to cover, and we're really excited to see what you're up to next, especially coming into 2018. So you take care, and I hope to talk to you real soon.
Mitchell, this has been a true pleasure. I thank you for your time. I thank you for the research you've done. And as I said, I'm happy to come back anytime you want.
That's awesome. Hey, listen, you take care, and I'll be talking to you soon.
Thanks so much. Bye.
Bye-bye now. Until next time. Please subscribe subscribe to my email list at mitchellchadro.com/signup. You will get all the full interview transcripts, my ebook, 30 Tools to Start Up, where I talk about these free resources in show 006. You'll get the startup checklist, education and training materials, and other resources just by signing up at mitchellchadro.com/signup. Back at mitchellchadro.com/signup, help me boost the rankings of the Listen Up Show, the Startup Entrepreneur Podcast, by providing a well-written review in iTunes. mitchellchadro.com/iTunes. It helps other people find the show. If you actually need instructions on how to do this, you can find that back at mitchellchadro.com/signup. Thank you so much for subscribing to my email list and providing a written review on iTunes.